Hey everyone, welcome back to Corporate Decoder, where we sometimes find out companies are doing everything but improving their core business. Today, we are diving into SRX Health Solutions, Incorporated's latest filing, which reveals some really interesting and maybe a little shaky moves they have been making behind closed doors. Think less about breakthrough cures and more about creative ways to keep the lights on. Before we jump into the nitty-gritty, if you find value in these deep dives into corporate filings, make sure you are subscribed. And hey, we've got a fantastic Discord community where we break down more of these filings in real time. The link is in the description below, so come join the conversation. So what is this document all about? Well, SRX Health Solutions Inc. or SRX HSI as we'll call them, has issued a Form 8K. This is basically a heads up to the public that something important has happened, something that investors need to know about right away. And boy did they have something to report. First, the company itself. SRX Health Solutions Incorporated says they were incorporated in Delaware. That is pretty standard. What is a little more interesting is that their common stock trades on the NICE American under the ticker symbol SRXH. It's like our everyday stocks, but for bigger companies. Now let's get to the juicy stuff. The company entered into a securities purchase agreement with some accredited investors. What does that mean? Well, these are sophisticated investors, meaning they are supposed to know what they are doing when it comes to complex investments. And what did they buy? Well, they bought shares of Series A convertible preferred stock along with warrants. Think of preferred stock as a special type of stock that usually gets paid back before common stockholders, and warrants are like options, giving the holder the right to buy more stock later, often at a set price. The total deal was supposed to be for up to a whopping $30.46 million, but on the 31st of October 2025, they actually sold 19.035 shares of this preferred stock and over 54 million warrants for about $15.23 million. So they sold about half of what they originally planned. This money came in either as cash or by cancelling out some existing debt they had from something called the July Note and July Warrant. Let's talk about these warrants. They have a starting price to buy the common stock of about 61 cents per share, and they last for 3 years. But here is where it gets a bit complex. This price can go down if the company issues new stock at a lower price or if certain bad things happen, like a default. It sounds like they are trying to give investors a safety net. But sometimes these clauses can become quite complicated to track. Now, for the Series A preferred stock itself, they designated 75,000 shares of their authorized preferred stock for this. Each share has a face value of $1,000. This preferred stock ranks higher than common stock. That means if the company were to go out of business, these preferred stockholders get their money before the common stockholders. The preferred stockholders are also entitled to dividends, but only if the common stockholders get them too. It is kind of like a follow-along bonus. If the company issues new stock or rights to buy stock to its common stockholders, the preferred stockholders get to buy those too, as if they already owned the common stock they could convert their preferred shares into. It's to make sure they don't get diluted or left behind when the company offers new opportunities. This is a big one. Each share of Series A preferred stock can be converted into one share of common stock at a fixed price of about 61 cents per share. This conversion price can also adjust, especially if the company does things like stock splits. But if something bad happens, a so-called triggering event, the conversion price can drop even lower. This alternate conversion price is the lesser of the normal conversion price, or 90% of the lowest average stock price over 5 days. Triggering events include things like the company's stock being delisted, failing to pay dividends, or even bankruptcy. This is a strong signal that this preferred stock is meant to protect investors in case things go south. Now, for this whole arrangement to work, SRX Health Solutions Incorporated is going to need shareholder approval. They plan to ask their shareholders to approve a massive increase in the number of authorized common stock shares. We are talking from 200 million to a crazy 5 billion shares. That is a 25-fold increase. This suggests they anticipate needing a lot more shares for conversions and other future financings. If the company gets bought out, the preferred stockholders can demand that their shares be exchanged for cash or other assets based on a specific calculation. It is another form of protection for them. The company also has the right to buy back all of the outstanding Series of preferred stock, but it is going to cost them. They have to pay 125% of the value of those shares. That is a 25% premium. They can do this at any time, which gives the company flexibility, but at a significant cost. The company is also restricted from certain major deals like mergers, unless the new entity agrees to take on all their obligations related to this preferred stock deal. This is to ensure the terms of this agreement are honoured even if the company structure changes. Interestingly, the holders of this series of preferred stock don't get any voting rights. They can't vote on company matters. This is common with preferred stock, but it means they are primarily investors focused on financial returns, not on shaping company strategy. The company has also agreed to certain restrictions. They can't, for instance, repurchase their own stock or pay dividends on their common stock other than what is already committed. They also can't take on a lot of new debt or incur many new liens. This means cash is being prioritized for this preferred stock deal and its obligations. And to make sure they can actually convert all this preferred stock, they have to reserve at least 200% of the common stock needed to convert all outstanding series of preferred stock. This is a hefty number, showing how important this conversion right is for the investors. On top of all this, on the 31st of October 2025, they signed a registration rights agreement. This means they have to file paperwork with the Securities and Exchange Commission, the SEC, to register the common stock that will be issued when the preferred stock is converted or the warrants are exercised. This allows those shares to be legally traded on the open market. Now for another twist, remember that common stock purchase agreement from the 7th of July 2025, the one where an investor committed to buy up to $50 million of common stock. Well, on the 28th of October 2025, they amended that agreement. They increased that investor's commitment from $50 million to a staggering $1 billion. And as part of that amendment, they issued another $20 million convertible promissory note to this investor. Convertible notes are similar to preferred stock in that they can be converted into equity. This suggests a very strong, albeit complex, relationship with this particular investor. This section essentially rehashes the financial obligations we just discussed, particularly the promissory note issuance previously mentioned in item 1.01. It is just a formal way of saying that new financial commitments have been made. This part is about securities sold that weren't registered with the SEC. This means they claimed an exemption, usually citing Section 4, Add 2 of the Securities Act or Rule 506 of Regulation. D, basically, they're saying these were private sales to sophisticated investors who know the risks and don't need the full public registration process. They've relied on representations from these investors to make this claim. Now, for some leadership changes on the 31st of October 2025, two directors, Lionel F. Conacher and David Allen White, resigned from the board. The filing states these were voluntary and not due to any disagreements about the company's finances, operations, or policies after their departures. The board committees were reconfigured. Michael Young, Simon Conway, and Joshua Epstein now form all three key committees: Audit, Compensation, and Nominating and Governance, with specific chairmanships assigned for each. On the 27th of October 2025, the company filed that certificate of designations we talked about earlier. This officially created and set the terms for their series of preferred stock. It was done as required by that securities purchase agreement. Finally, we have the list of exhibits. These are the actual documents that back up everything in this report. We see the certificate of designations, the form of warrant, the securities purchase agreement, and the registration rights agreement. Among others, these are the legal pieces of paper that make all these deals official. So, what is the story here? SRX Health Solutions Incorporated seems to be in a serious fundraising mode, but it is not through a typical public offering. They are relying on private placements with sophisticated investors for significant capital. The terms show a clear focus on protecting these investors, especially through convertible preferred stock and warrants with attractive downside protection and dilution safeguards. The massive increase in authorized common stock indicates they are planning for future dilution or significant growth requiring more equity. The departure of directors could signal a shift or perhaps a settling of affairs after these major financial agreements. The amendment to the common stock purchase agreement, increasing the potential investment to $1 billion and adding a convertible note, shows a deep commitment from at least one major investor and a very complex financial strategy. Looking at the numbers, while they secured around $15 million in this private placement, the potential for up to $30 million exists, and the overall commitment from one investor in the amended purchase agreement could reach $1 billion. This is a massive amount of potential capital. However, the reliance on these types of complex private financings, coupled with features designed to protect investors from downside risk, suggests that the company might be facing significant challenges or sees a critical need for capital that isn't readily available through traditional public markets. The key risk here is dilution, with so many shares being potentially convertible and warrants exercisable. Existing common stockholders could see their ownership stake significantly reduced unless the company's value grows exponentially to offset it. The company seems to be betting heavily on future growth to make these complex financial instruments work for them. In conclusion, SRX Health Solutions Incorporated is undertaking a significant financial restructuring and fundraising effort. The company is clearly prioritizing securing capital and doing so with terms that strongly favor its new investors. Whether this is a strategic masterstroke or a sign of financial distress remains to be seen. But it is definitely a company to watch closely. What do you think about these complex financing deals? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate insights. And seriously, check out our Discord. The link is in the description. It is a great place to learn and connect. Thanks for watching, and I'll see you in the next one.